don't know if you guys are familiar with this book. The book is named, hold on. The book is titled 401 Chaos, 401 Chaos. And basically, this book opens up your eyes to some of the things that are going on inside of the mutual fund industry. So the two books that I'm going to talk about today, the topic that I'm covering today, this is one of the books. As you could see, I have known about this book for a long time, but I just purchased it on August 7th, and I've been reading through it in my free time. But also, there's another book, and you can actually get this book for free, right? This book is called the KRP book by Damon Lupo. And if you go to their website, they'll send you this book all for free. So it's going to be there. Damon Lupo, he's been doing this for a while. So I just wanted to share those two books. And when we get to the end of the presentation, I'll come back to those books at the same time so that you guys could have an understanding of what was there with those books. So let's get started here. Let me go into slideshow mode. And of course, this is to be an interactive conversation, right? I've been doing this now since 2014. So I've been working with these types of vehicles and products for quite a time. So I've probably encountered as any and all questions that there are, but I hope to get stumped on this call with any questions that you may have of me. So let's get moving on. One of the disclaimers that I will tell you about on this forum is that I'm just an investor expressing my personal opinion and not a financial advisor, attorney, or accountant. Consult your own financial professional before making any financial decisions or transactions, right? You guys are the stewards of your life, your capital, your retirement, and I want you to be educated so that you can take control of one of the things that I firmly don't believe a lot of people are spending a significant amount of time. On my meetups, right, I have a code of ethics. We do not accept any money from any sponsor or platform for anything, including postings, reviews, referring investors, affiliate links, or advertising, right? The reason why I put this here is so that you can have a high level of confidence that the information that I'm sharing with you is information. The information that I'm sharing with you is information that I believe in. Not that, I'm like Kim Kardashian, putting something on Instagram because they're paying me $1 million. As you guys can see, I'm not a highly compensated endorser at any point in time, and I don't expect to be in my career as a whole. So I just wanted you guys to know the code of ethics that I ascribe to, so that you know that the information that I'm sharing with you is information that I have come through all on my own. As we set the agenda, right, if you do know what an SD, self-directed IRA is, we're going to go over the definition so that we can lay the foundation for the conversation that we're going to be happening. Then I want to do a compare and contrast between a self-directed, right, and a traditional retirement, right? We're going to study the impacts of fees on your investment portfolio, because guess what? There are significant fees, and I had a conversation yesterday with a colleague to go in. I actually had two conversations with two colleagues yesterday to go in and look at the fees that their mutual funds are subscribing to their 401k plans. And you got to remember, when you're at your company, you only have the option of investing in mutual funds, right? So the mutual fund companies know that they have a captive audience that can't go anywhere, right? So if you're going to participate in the 401k, they know that they have you there until you change jobs. But one of the things that I can subscribe to you is that most people, it's not like in the 60s, the 40s, and the 50s where you would have an individual who would work at one employer for their entire career. Next, we're going to talk about some of the providers that are there, right? So there are different providers who can actually help you out. I will also tell you about the one that my wife is using, which is Rocket Dollar. And I'm personally using Broad Financial along with Madison Trust. There are some rules around this, and then we'll summarize it and then move on to a Q&A type of session. All right. So what is a self-directed IRA? And a self-directed IRA is written into the 1974 code around ISRA, right? Basically, a self-directed IRA or all retirement funds fall under the Department of Labor. So sometimes referred to as an alternative IRA. It's a tax-deferred retirement platform account that allows investors to diversify his or her savings beyond Wall Street into real assets not available with a traditional IRA like real estate. I've been investing in real estate through my self-directed IRA probably since 2014, 2015, once we returned back from Singapore. You can invest in foreclosures because you can use the funds from your self-directed IRA to go on the county steps and bid on houses that are being foreclosed. You can do mortgages, and by mortgages, you can become a hard money lender, right? You can buy precious metals like gold and silver. You can even use your self-directed IRA to purchase a private business or to go into business. I mentioned this already, but similar to mortgages, private loans are something that you can do. Private placements, which is what we do with our syndications, you can go into commodities, intellectual properties like movies, books, and songs. You can even use it to buy stocks, bonds, of course, mutual funds. You can buy cryptocurrency. You can purchase NFTs. And one favorite of a lot of people that I know, especially those who reside in Maryland, which is a tax lien state, you could actually purchase the tax lien. And what a tax lien basically says is the government will put a lien on your property, right? Because you failed to pay your taxes. A person or investor purchases the tax lien and they work with you to pay off that tax lien. If you do not pay off that tax lien, they can foreclose on your house because a tax lien, right, is superior to all kinds of debt that you have on it. Now, of course, the bank may step in and say, if there's a mortgage on it, the bank may step in and say, no, we'll fight this because, hey, we have a mortgage on it, so we're not going to allow you to take the property for, say, $2,000 or $3,000 when there's $100,000 debt still outstanding on the property. But when the government puts a lien on your asset, guess what? They typically have superiority over any other types of encumbrances that are on the asset. So I hope that makes sense to you. Let's move it forward. So, as I mentioned to you, with a traditional IRA or 401k, right? These are the assets that you can invest in, stocks, right? You can purchase individual companies directly. So you can purchase Apple, you can purchase Tesla, you can purchase Amazon, you can purchase Google directly inside of your self-directed IRA, right? That would probably have the least cost to you, right? Because you're just going to have the transaction expense, right? And at this point, a number of brokerages are not charging you any commission to move into and out of a stock position because they're making money on the back end by the company that's going to be servicing the transaction, right? You can purchase bonds. I would say the only reason why you would want to purchase bonds is because you're looking for some type of guarantee or stability. That's what bonds are going to give you. Of course, mutual funds are there, but what's going to happen is the mutual fund company who you are with, right, will basically, like Google puts its preferred advertising and products or sponsors at the top of the page. If you're with T. Rowe Price, they're going to have their mutual funds at the top of the page, or Fidelity, or even Vanguard. One of the things that I want to stress to you, right, is please do not go with the target date funds. The reason why I'm saying that you do not want to go with the target date fund is because those are actively managed funds, and those actively managed funds are going to have the highest expense ratios that are there, right? So basically, the expense fund is saying, oh, if you're 30 years old, we're going to have your portfolio at a certain balance between equity and bonds, right? So a certain amount into stock is probably going to be 70. Now, I would say if you're in your 20s or your 30s, they're going to have you at 80-20 stock and bonds. And as you age, they're going to change out the balance of the portfolio such that it slowly transitions out of equity stocks and more into bonds. But if you look at the performance of bond funds, it's like ridiculous, like 1%, 2% growth, right? 2% growth in this day and age with inflation out the wazoo, right? You're actually losing money. And I told my colleague, and I tell anybody, that in today's day and age, if you are going to be putting money into a traditional checking or savings account, don't do it. Go to Las Vegas and have a party like no other party at all, because with inflation at high 8s and 9%, the purchasing power of that dollar is being eroded, and all that the bank is going to be doing is giving you 0.01%. We looked at Fidelity, we looked at Bank of America, and what we found is that the rates up to about $100,000 in the account had gone up to 0.05%. There's no way, right? 0.05% for $100,000 in that account. So why? I believe that the self-directed IRA is a much better opportunity for you, because the self-directed IRA allows for you to take control over your retirement. Literally, it puts you into the driver's seat so that you can say, hey, I'm either going to win or I'm going to lose, but I'm betting on me. So when it comes to a self-directed IRA, right, you can invest in real estate, right? You can create your own private company and invest in that private company using the proceeds from your self-directed IRA. precious metals, oil and gas, mortgage, promissory notes. I've even heard of someone investing in livestock using their self-directed IRA. It's an alternative investment. If you can do it, do it. I just say stay within the realm of your the boundaries that are there. I'm going to pause really quickly and ask, are there any questions about the traditional versus the self-directed IRA? All right, I'm doing such a great job of explaining this complex topic that you guys don't have any questions. So let's keep moving forward. All right, one of the things that many people, as I have a conversation with them, they do not understand that mutual funds are in most instances actively managed, right? So there are purchase fees. Some funds charge this fee when you purchase their shares to defray costs to the fund associated with your purchase. This is really going to be for those third-party retirement plans that aren't like the majors. So I would probably go, the majors I'm talking about, T. Rowe Price, Vanguard, Fidelity. I don't really see purchase fees there, but I did see purchase fees when I was working with smaller companies where they had a third party who was managing the retirement account, and they would charge a fee. Then there are account fees, right? Imposed if account falls below a particular level. So they want to say to you, it's like the bank that says, oh, if you don't have $5,000 in the account, we're going to charge you a monthly service fee. So there are account fees that the mutual fund can levy on you, right? Then there are exchange fees, right? That's for when you're moving in and out of the fund, imposed when exchanging fund shares for shares of another fund within the same fund group. Come on, they're literally going to charge you because you said, oh, I no longer want to be invested in an international fund. I want to move those monies over to a domestic fund, but they're going to now charge you for that, right? Then they're going to want to charge you a redemption fee, right? When you redeem your shares in the fund. So not only will they charge you to exchange one fund for another, but they're going to charge your redemption fee as you move out of one fund into another. And the other charge that they can charge on to you is the sales load, including sales charge on purchases or deferred sales charges a load. This is the broker, right, charging you a commission. And I remember when I was working with Edward Jones, right? Edward Jones was charging me all kinds of fees. And guess what? The guy, he was telling me, hey, go move into Microsoft or move into Expedia. Basically, he had me, I was in Seattle at the time, and he had me investing in a bunch of local companies. And because I was not educated, I'm going to use the term, I wasn't educated in how this all should work. I wouldn't say that he took advantage of me, but because I didn't know about the other options or the alternatives available to me, I would kind of say he did, in a way, take advantage of my ignorance. But that's okay, right? He was running the business and I didn't know any better. But the reason why I wanted to have a conversation with you today and bring to your attention the number of fees that are there is that mutual fund companies, they make money in two ways. They charge your company for managing and administrating the fund on behalf of the company. And two, they're charging you these other fees The fees here really are going to impact you because it's reducing your compounding effect that goes with owning the money. And I'm going to show you a simple table that I often speak to about the corrosive power of fees on your ability to earn, right, and grow your money. You'll see it in the graph that we have coming up. So I'm going to be moving on from here. Are there any questions about fees?
No questions.
All right. Well, there are more additional fees. The one that I particularly loathe is this one called the 12B1 fee, right? And they also have other fees such as marketing fees. With my colleague who I was speaking to yesterday, we're both at Dell Technologies, and there is a record-keeping fee that Fidelity charges every time every time I get paid. The transaction usually goes through on that following Monday, right? It's a record-keeping fee that they're charging me because now I was able to purchase a little bit more. Right. And that money erodes you over the year, because I was thinking to myself the other day, well, maybe I should just have one fund that I'm investing in, which is the S&P 500 index fund. I should probably only invest in that because then I will have coverage across the S&P 500 and I can just ride the wave of the stock market. I want to show you guys another book. And this is the book. So I want you to see it here. First, I want you to see the size of this book, right? This book has probably, I'm not going to include the index. This book has 723 pages. I don't know if you can see that, right? But basically, Benjamin Graham, the author, is the gentleman who actually taught Warren Buffett how to trade. So this is the reason why, this is the reason why I picked up this book, is because this is the guy who Warren Buffett learned to trade from. And one of the, basically, I had read several chapters of it, got up to about 100 pages. They kept repeating the same thing over. And they said, if you do not have an advantage in the stock game, you should just buy the mutual funds, because you're going to rise when the tide is rising, lower when the tide is lowering. At that point in time, when I read this book in, I think it was about 2015, 2016, I moved all of my monies from, this was with the company who I was with at the time. I moved all of my monies out of actively managed funds into index managed funds, because the index managed funds had the lowest expense ratio. I can tell you right now today, just because I looked at it yesterday when I was having this conversation with my colleague, but the expense ratio on the Fidelity S&P 500 index fund is 0.015%. It's money, right? But what we did is we did a comparison to an actively managed fund that had an expense ratio of, I think it was 4%, 4.35%. right? So like it was a significantly higher, but the returns were nominal, right? The returns that the fund was producing was nominal, but here I am paying all of these additional fees. So I wanted to share that with you just so that you have a little bit of understanding and feel for how the fees are going to erode you. And here, what I'm going to show you is the corrosive effect of having a mutual fund, right? And the fees, because we were just talking about fees, right? The fees and where you would land after a portfolio from investing $100,000 over 20 years. So here you'll see that with a 4% growth annual, right, at 0.25 annual fee, you will grow that $100,000 over 20 years to about $210,000, right? Now, if the fee is a little more at 0.50%, you'll end up where this red line is at about 200, just south of 200K, right? However, with the mutual fund, that same $100,000 invested, all we're doing is we're talking about a 1% annual fee, right? That $100,000 with a 1% annual fee has earned over a 20-year period just south of $180,000. You may say, Lee, why are you showing me this? I'm showing you this because the difference over a 20-year period is nearly $30,000. Now, $30,000, depending upon where you are within your journey, $30,000 can equate to another 6 months, another year, another 2 years of investing, because the average person is in their career for 40 years. So if you were to look at this same $100,000, right, because these lines are going to diverge as you go out more in time, right? But that's the power of compound interest. That $30,000, just because of the fees, you have lost $30,000 in compound earning potential. I believe that that's going to hurt. And I think people, they need to have this vision of looking forward for the next 20 years and having that firm conversation with themselves and their financial advisor to understand, yeah, fees are going to be a part of anything that you do, right? Fees are going to be a part of anything that you do. However, I want to minimize my fees as much as I can. So this graph and this presentation will be available on our private Facebook group. If you haven't already joined, please do so. Value Investment Partners, Loudon, REI Connect. All right. However, you have to do a compare and contrast with the setup fees for a self-directed IRA are going to be about $350, right? Or if you were to go with a different company that, do you care about the name of the LLC that's being created? When I created my self-directed IRA, the name mattered to me, right? So I went with the custom version. If you give me 1 sec, I'll show you the binder. So apologies there, I had to step away. But this is the binder that I received from the Broad Financial who created my self-directed IRA. So in my self-directed IRA, they have a user's guide, which basically is a high level to help you to understand how to and how not to use your self-directed IRA. Of course, they can't go over every single scenario that's available to you. But in here, you will also find your articles of incorporation. So mine's is an LLC. There are certain states that don't allow for single member LLCs. So they would probably set you up with a trust or something like that. But that's what you're paying for when you have these different advisors. Because this is an entity, they create the operating agreement. So there's about, I would say in mine, there's probably about 20 pages of my operating agreement that lays out how I can conduct and carry myself forward. There is also the FIN, the EIN number that's associated with your LLC, right? And then there are some other administrative forms here. But as you can see, the fees for maintaining a self-directed IRA are about $180 to $320 a year. Even if you multiply that over 20 years, it's not going to equate to $30,000 in erosion. No ifs, ands, or buts about it, right? I would take 320 every year, right, and land at about, $3,000 to $6,000, right, over a $30,000 erosion of my account. So we just wanted to share with you the different vehicles that are available to you, right, depending upon how you want to set it up, right? I'm with, as I mentioned to you guys, I'm with Broad Financial. My wife is with Rocket Dollar. For the most part, we never have to talk to either of these companies. We never have to have a conversation with them because the investment is returning the cash flows into the account, and these fees are coming out of there, but it's all tracked and monitored at the same time. So here, what we wanted to do is share what a projected investment portfolio is all about and give you an idea of how we have leveraged our self-directed IRA to invest, right? And the opportunity that is available to you if you should go and take those stranded 401ks. There are certain plans that will allow you to do a 401k rollover from your existing plan to a self-directed IRA. You have to speak to your administrator or whomever at your organization is responsible for benefits to see if that is available to you. But some of the things that we evangelize on is the fact that we never invest in a deal that doesn't have a preferred return, right? So as you can see here, there's an opportunity. It has a 7.5% return, preferred return here. What is the preferred return? A preferred return basically says that the investors get paid out before the operator gets paid out. That's significant because there are some operators who will pay themselves before they're paying their investors, and they will only pay their investors when they sell off the asset, and who knows if that's going to be 2 years, 3 years, 4 years, 5 years. I believe that these whole entire deals do not happen without the investors, so the investors need to be looked out for first. You can use what is your average annual cash on cash return, but it's one of the measures that we look for as we're investing in deals, but it's not the primary driver. However, at the end of the day, what matters most is how much is returned to you after 5 years. So that's 110,821 plus the initial investment of $100,000, which gives a total return of $210,821 after only 5 years. Now, let's talk about what happened yesterday, right? The Federal Reserve chief or chairman, Jay Powell, came out and said that the Fed's mandate is to ensure that inflation is under control. That's what they said. Inflation has to be under control, right? And with that being said, he says that they're going to continue raising interest rates until they're back within their projected range. The Fed wants inflation to be at 2%. And right now, I believe it was at 9.1 in June. It was at 8.5, 8.7 in July. It means that it's going right, but there is more that they can do to take stimulus out of the economy. But whenever they do this, right, that's going to slow down companies from hiring people. It's actually going to lead to a situation where companies don't see demand, they're actually going to start laying off people and things of that sort, or wages aren't going to rise, etc. So those are some of the things that you have to think about when you are investing in any of these types of portfolios, right? But what you're trying to do here, and one of the things that I mentioned is if you wanted to buy a stock, you have to pay whatever that stock price is trading. Over here, the reason why we're able to get these types of return is through leverage, right? I don't know if you guys understand what the banking system allows the bank to do, but for every dollar in deposits that the bank has, they can loan out $9 to $10 in loans. So you give them $1, they can loan out $9 or $10 for every dollar that you have on deposit, right? So the thing is, they're going to make money off of your money because the loans that they're going to produce are going to be at like 5%. However, the bank is only going to give you 0.01%. How can that be? How can that be? I think it's highway robbery. And I could tell you about a whole bunch of different strategies that I put in place, right? Such that I'm not feeling like a sheep per se. The bank isn't going to use me and use my capital for my hard-earned money. I'm going to try to maximize and get as much as I can get out of my money. And I spoke to two colleagues about this yesterday, and they were a little bit shocked that the high interest rates that these opportunities that I shared were given them. All right. We do not receive any referral fees, etc. From these companies. We will if you ask us to refer you to Broad Financial, they will give us $100 for the referral. All right, but there's the Entrust Group, there's Equity Trust. Equity Trust has been around probably since I first heard about self-directed IRAs, and that was in the not years between probably be around 2005, maybe 2008 was when I first heard about Equity Trust. And Equity Trust, because there are a lot of rules and regulations around these types of transactions, they basically hold your hand really tight to make sure that you do not go out of bounds in the violation with your self-directed monies. right? However, companies such as UDirect and Broad Financial, they have something called checkbook control. So for instance, if there was an investment that I wanted to move into tomorrow, I don't have to call an administrator. I have access to those funds inside of a bank account that I can wire funds to an opportunity. You guys know how fast the wire goes. So basically, from top to bottom, I say, depending upon how much you trust yourself, right, determines which vehicle you'll use for your self-directed IRA. If you can keep your hand out of the cookie jar, right, you don't want to get caught in there having a chocolate chip cookie. If that's the case, I would say go for a checkbook IRA, right, because you don't need access to those funds. However, if times are a little bit tough, things are a little bit tighter, I would say go with the custodian such as Equity Trust, who's going to make sure that you do not get into trouble, and you would have to work with them. But they kind of you guys can tell already that I don't like the fees. One of the things that I found with Equity Trust was when I wanted to make an investment, I wanted to do it yesterday, right? If I wanted to move on a transaction faster with Equity Trust, I would have to pay 25 or 50,000. This is now 10 or 15 years removed. I would have to pay a fee for them to expedite the transfer. And I just thought, hey, that rubbed me a little bit the wrong way, because you guys know I don't like the fees. Now, as they say, there is no golden duck, right? There are hard rules, right, for the transactions that you can do within your self-directed IRA. You cannot go and buy art. So no Picassos, no Warhols are going to be purchased using your self-directed IRA. Stamps, antiques, non-precious metals or coins, S corporations, right? General partnerships and private companies that employ you and or your spouse, right? So those are some of the restrictions. As I mentioned inside of my booklet, I have a section that talks about, it's the user's guide. And one of the things that you find inside of the user's guide, I'll read just one of the statements. It says, if the LLC is owned by two or more IRAs, the ownership structure, i.e. the percentage of ownership of each IRA, can never change. This means that all transfer of funds between the IRAs and the LLC must be based on the original percentages. For example, if Mr. Smith's IRA initially invests $25,000 into the LLC, and Mrs. Smith's IRA initially invests $75,000 into the LLC, then Mr. Smith's IRA owns 25% of the LLC, and Mrs. Smith owns 75%. Therefore, if Mrs. Smith wishes to transfer $7,500 from the LLC back to her IRA, then Mr. Smith must transfer $2,500 from the IRA, from the LLC back to the IRA. The same would apply if the transfer takes place from the IRAs to the LLCs. Right? So there are some rules about this. You cannot make investments into anybody above you, meaning anybody like your parents, right? You can't invest in any of their companies and businesses. And the same applies to anyone below you, right? That's your children, etc. There are certain rules that are there. And, there's a great book by many of the people. Gene Tolbridge is the book that really got me into all of this. It's called It's a Whole Different Business. Great book if you ever looked into it. Some of the other restrictions that are there are UBIT, unrelated business income tax. That's if you create a business using your self-directed IRA, because you have had an advantage over someone who's using post-tax money. You're using pre-tax money. This tax is going to apply to you. However, from what I have read over here in the QRP book is that if you set up a QRP, then you don't have to worry about UBIT and UDFI, right? So there's another reason, depending upon what it is that you're going to do with the investment, where you should invest. Should you go with a SD-IRA or should you go with a EQRP? And the E stands for enhanced, right? There's a conversation that you need to have with yourself and with your advisors as to which one you should invest with, right? All right. So just to summarize, right? What I mentioned to you, because most people aren't working at one company for 40 years, 50 years, even 10 years. I would say the average tenure at most companies nowadays is 3 to 5 years, right? There are certain arguments as to whether or not if you should invest in your 401k. We're not going to debate that here. I am thinking about that. I am reading 401k OS, right? And we're going to have that debate at a later date. My thinking today is that your company is going to match whatever you put into your 401k up until a certain number. I say today, I'm a human being and subject to change. Today, go and invest that, right? They're going to give you money. The biggest counter argument that I have heard is that if you were investing with post-tax money that you have already paid taxes on, any investment that you move into is taxed at capital gains, right? And capital gains could, at that point in time, will be long-term, which would be around 15% versus short-term capital gains, which is around 20%. However, earned income can go all the way from like 12 to 15%, all the way up to 37, 42%. So you guys know I stress all of the time, it's not how much money you make, it's how much you keep. So as you are doing your entire portfolio and strategy planning, you have to think about what's happening right now, but you also have to think about the future, because I don't know if you guys know this, but there's something called RMD, right? Required minimum distribution, that you have to take out of your 401k. Starting at 70 and a half, I believe it is, but I believe that the legislation has recently moved that up to be about 72, and it may go up to 75. The reason why we're talking about this, and my thinking is, I like a retirement fund because by the time I get to my retirement age, I will not be having significant earned income. So if I don't have significant earned income, my tax bracket at that point in time will probably be 12 or 15%. I hope that makes a little bit of sense to you, but that's where we were. And I totally got off tangent just a little bit because, that's a conversation that I'm a little bit passionate about. But I want to open it up because you guys have been way too quiet, and I like to have an interactive conversation. So come on, somebody, give me one question today, please. I'm begging you.
Hi, Lee. I'll just, it's a simple question again. You said this is going to be available, what? We just have to, it's going to be posted on the Facebook group or where?
Well, the presentation is in our private Facebook group.
Uh-huh.
The video, the recording, after we edit it and then put our bumpers onto it, will be onto our YouTube channel. So you can just go to the YouTube channel and subscribe to it. We're not putting a whole lot of stuff up on the YouTube channel, right?
Sure.
We just do one virtual meetup per month, right? And we're probably going to turn our video, our blog into a video at the same time, because if you guys go to the Value Investment website, Value Investment Partners website, you'll see that we probably have about 40 blogs that are out there right now that basically tell you how we have invested, how we have grown our net worth, what we have done in the real estate space. And, it's all free information. So you can, educate yourself at your pace.
Lee, could you repeat that again? What we could go to see what you guys have invested in?
Okay, I'm going to you guys know my website, valueinvestmentpartners.com.
Sure.
Right. So I'll put it in. Can I ask? No, I'll do it.
Yeah.
So I just put in the chat my website, and you guys could go there. And if you go there, you see a number. If you go there under how we do this or something like that, don't hold me to it. But it shows you our portfolio. And in our portfolio, you start to see many of the deals that we have entered into and exited. And most of that has been over the last 3 years. 3 to 5 years, from 2017 to 2018. But what that shows you is, I went all in 2017. All my past 401ks that I had access to the funds, I put all of that money into multifamily syndications, right? And I'll tell you, I'm being as honest and transparent as I can be with you. I literally lost my cool in 2019, 2020 when I'm hearing that there's something called the pandemic coming, right? Because I said to myself, if people can't go to work, they're not going to be able to pay for where they live. I'm probably going to work for the rest of my life. One thing that I didn't calculate into my equation was that the government would step in to make sure that people weren't homeless, right? But also the pandemic allowed people to decide that they no longer wanted to live in cold and high income states, and they decided to move south. I was already investing in the South, Florida, the Carolinas, Georgia, Texas. So, unbeknownst to me and everything that I was doing, I'm much better at performing my analysis and due diligence today. But I was able to invest in those areas where everybody was moving to. And guess what? We've been able to exit many of our investments, right? And literally, I would say the $750,000, $800,000 that I had invested in all of those have nearly doubled themselves in 3 to 4 years, right? So now we're probably sitting at $1.6, $1.7 million inside of the retirement account. But also that money is now back in and investing again. So, if I could double every 5 years, you guys see where I'm going with this and how I'm planning for my future, right? I'm planning for my future to be to the point where my my net income is invested, right, is invested to the point where it throws off enough cash to cover my expenses, right? And at that point in time, I don't have to work because my net worth is producing the income that I need in order to support myself and my family. Right. I gave you a synopsis of what I'm doing, but slowly but surely, I'm trickling the Lee Johnson system out, the value investment VIP wealth strategy out, right? And I'm also writing a book so that you don't have to have access to me right? You can go into the book and you can learn everything that I've done to basically double my net worth. And when you calculate your net worth, you don't typically, especially for accreditation purposes, include your primary residence. So I'm not including my primary residence in my whole entire net worth number. So Teresa, I know I was a little bloviated there, but I have put my website into the chat, and you can go there to find out different terms that I may have used. I have a glossary there, right? I have all of our exited transactions.
Okay.
One of those is, I think it's Atlantica. We exited Atlantica probably June or July timeframe. So that one is now closed at the same time, right? We just did you guys probably saw my email where we just closed out a raise for our Tennessee deal, which is 72 units, and we're building another additional 48 on top of that. We're also working on another deal in Texas that's, I thought it was 383 units, but my wife told me that it was about 480 something units. And we're going to be working with another partner of ours on a property in Columbia, Maryland, but they haven't shared with us all of the details on that one just yet. But you guys have to make sure that you have gone to our website and you have joined our Club VIP, which allows you to stay abreast of what we're doing, right? Because right now inside of our database, we have about 400 people. It's starting to become a little bit difficult for us to have that one-on-one conversations. I'm never going to try to get away from the one-on-one conversations, but at 400 is going to lead to 500, 600, 700 people in my database, 800 in my database. It's going to be a little difficult to get in touch with me. So then I got to develop my system such that the people who we bring on have the same values that we have, right? I don't want anything that's associated with the Lee Johnson brand to, get into the wrong hands, if you guys understand what I'm saying. All right.
Definitely.
Any other questions? I see Ryan there.
Yeah.
Maya there. I see.
Yeah, I have one.
Go ahead, Ryan.
I know with like a Roth IRA, there's like a certain limit on how much money you can put in it, right? Is it the same for a self-directed IRA?
Well, when it comes to a self-directed IRA, remember, you're going to be transferring funds that you have already put into a 401k.
Mm-hmm.
So I believe this year, the maximum that you can put into a 401k is about either 20,500 or 21,500, right? Unless you are, if you're younger than 50. Right. But once you get to 50, I believe that they're allowing you to do some catch up and put about an extra $5,000. So you can put almost $30,000 away inside of a 401k. Now there's no limit to how much you can transfer in, right? When I transferred in a couple $100,000, right? There's no limit to how much you can transfer in, right? But you are limited with the 401k as to how much money you can put into the account per year.
Got it. No, that makes sense. Thank you.
Pleasure. All right. Any other questions? I see that we are at the top of the hour. So what I'm going to just do is share with you that, if you want to get in touch with me or my wife, because you might have a question, right? We're doing a lot of different things now. We're doing the multifamily syndication. We're also helping people to set up their private banking strategies using whole life insurance. But if you want to get in touch with us, right? All you have to do is either go to the calendar and schedule 30 minutes with us, or you can text meetup, right? You can text meetup to 571-444-8474. But what for this particular session, if you want me to introduce you to Broad Financial, all you have to do is send me a text to this same number with SD-IRA, right? Send me a text with SD-IRA, and I've shared a number of people with Broad Financial, and there's going to be someone who gets you back in touch. And by coming through us to them, right, you saw that it was $1,400 that you can use your 401k monies to set up. They'll give you $1,000 discount on that. No, I think it's a $400 discount. It's some type of discount that they would give you if I were to refer you to them versus if you were to go directly. So all you got to do is text SD-IRA to 571-444-8474, and I can handle that. I probably won't do it today just because, it is the weekend and just trying to hang out just a little bit, but I will definitely get to it before Monday. So, as you guys know, we're doing 2 meetups a month. One is in person, right? We're doing our in-person one at a coffee shop over here in Sterling, Virginia. That's going to be on September 10th. And we're going to be talking again on a virtual setting on 9/24, where we're probably going to go over the privatized banking strategies, right, that we're using. Is basically where we're using whole life insurance policies so that we can become our own bank. But it's a whole story on how you have to set it up. And now we have the capabilities to help our partners to set up their banking policies at the same time. So that's what we're going to be doing there. So that's all that I have from a presentation perspective today. One of the last things that I wanted to do, and this is a little bit of trivia, but if you were to save a penny a day for 30 days, can anyone tell me how much you would have at the end of the 30 days? And the penny doubles every day for 30 days. Some of you know, I know. Somebody want to be shy. Come on, Rosalind. I know you already know, but you don't want to talk today, I guess. All right. So what I wanted to do is, as the final piece for today, is to share with you. I hope this one has the chart, right? And now, there is no investment that allows you to double your investment over 30 days, right? However, the reason why I share this with you is because I want you to see the power of compound interest, right? And if you save a penny on day one and that penny doubles every day for 30 days, at the end of 30 days, you will have $5.3 million saved. And the reason why I'm sharing this with you is because I wanted you to see the power of compound interest and why it is that you don't want to be investing your money with individuals or companies that are actually going to erode your growth potential. I hope that makes a whole lot of sense to you guys, because that erosion means that you guys are going to be working that many more days going forward. I hope that makes a lot of sense.